Welcome to The Explainer. Valley National Bank just dropped some pretty impressive earnings. But honestly, that big headline number, it doesn't even begin to tell the whole story. What we're actually witnessing here is a bank right in the middle of a massive, multi-year transformation. So the real question is it all paying off?
Okay, right out of the gate, let's talk about that headline number. A net income of $133.2 million for the quarter. Now that is a huge jump from the last quarter and a really strong signal. But a number like this, it doesn't just appear out of nowhere. It's not the start of the story, it's really the result of one.
So what is actually driving this? This isn't just some fluke, one-off good quarter. No, this is the payoff from a very deliberate, multi-year strategy to fundamentally reshape the entire bank from the ground up.
To really get what's happening with Valley today, you've got to understand the Valley of yesterday. We need to rewind the clock a little bit.
Think back to 2017. Valley was a pretty traditional bank, very heavily focused and concentrated in the Northeast. But since then, they have been on an absolute mission to diversify their business, to build something much more resilient. And this quarter's results? They might just be the clear sign we've gotten yet that the new Valley has finally arrived.
And this right here is where that transformation just becomes crystal clear. Look at this. In 2017, nearly 80%, 80, of their commercial loans and their deposits were tied to the Northeast. I mean, that is a lot of eggs in one geographic basket. Fast forward to today, and both of those numbers are way down, below 55%. This isn't some small tweak. It's a massive, strategic move to de-risk and diversify the entire company.
All right, so that's the big picture strategy. Now let's dive into these Q2 results and see the payoff in black and white. The CEO, Ira Robbins, he couldn't have been clearer. He said the whole game right now is about attracting low-cost, stable deposits. For any bank, that's the absolute foundation for everything else you do. It's about building real, sticky customer relationships, not just chasing hot money.
And you know what? It's working. While their local branches are still the core, look at this. Over a third of their deposits, we're talking more than $12 billion, now come from these newer specialized channels. That's money from areas like tech, private banking, and even international clients. This just makes their funding base so much more stable and diverse than it was just a few years ago.
Now, on the other side of the balance sheet, they've done the same thing with their loan portfolio. Yeah, commercial real estate is still a big piece of the pie, but the real engine of growth has been their commercial and industrial lending, what they call C&I. That part of the business has grown at a staggering 19% compound annual rate since 2017. That's huge.
Okay, next up, we have to talk about a super important metric for any bank: net interest margin, or NIM for short. The simplest way to think about it is this. It's the profit margin a bank makes on its loans. The higher the NIM, the more money the bank is making. It's a really key indicator of profitability.
And here, my friends, is the payoff. Look at this chart. Valley's net interest margin has now grown for 5 straight quarters, finally breaking that 3% mark. This is not a coincidence. This is direct, tangible proof that their big strategy, pairing those cheaper, diverse deposits with profitable loans, is working exactly as planned.
Of course, growth is only one part of the story. A smart investor always asks about the other side of the coin. What about the potential risks? So let's take a look at how Valley is managing any potential headwinds.
Now, the report wasn't absolutely perfect. There was one number that did raise a few eyebrows, and it was this one. Past due loans ticked up 2.4%. Now, on the surface, that might look like a potential crack in the foundation.
But, and this is a big but, the bank's chief credit officer jumped on this during the earnings call. He gave some really important context. Turns out that entire increase was because of just 3 specific loans. And even better, the 2 biggest ones were already resolved right after the quarter ended. So what this shows is that it was an isolated incident, not some worrying new trend.
You can really see this proactive mindset in how they're handling commercial real estate risk. They've aggressively slashed their concentration ratio, and now they're being way more selective. They're focusing on clients who want a full banking relationship, not just a one-off loan. They are actively managing the risk here, not just sitting back and waiting for something to happen.
So, with a strong quarter in the books and risks being actively managed, what's next? Where does the new Valley go from here? Well, looking ahead, management updated their guidance for the rest of the year. Here's a key takeaway for me. They're tightening their belts on expenses, getting more efficient, but they're still confident enough to project really strong 8 to 10% growth in net interest income. That combination tells a story of both control and confidence in their core profit engine.
And looking even further out, they've laid out a very clear and pretty ambitious path to higher profitability. They're gunning for a return on assets, or ROA, of over 1% by the end of this year, which is a key benchmark for bank efficiency. And beyond that, their goals for return on tangible common equity, or ROTCE, show this clear ramp up towards what they believe is their true potential, close to 15%.
So here's the bottom line. Valley's transformation is clearly working. The numbers are backing up the strategy. But the CEO himself pointed out that there's a disconnect between this strong performance and the bank's stock price. So that leaves us with the final big question. Will just executing the plan be enough? Will the market finally catch on and see the new Valley for what it is? That's the story to watch.